Hey guys, Dave Keller here with Market Misbehavior. Given the uncertainty in the world right now, in the markets, in society, and life in general, getting more questions than usual to the Final Bar mailbag. That's for my show, The Final Bar on Stock Charts TV. We do a mailbag segment twice a week, and I'm finding I'm getting more questions than normal, which is fantastic because it's a great opportunity to help people sort of along in their journey of navigating this market. In particular, I'm getting some questions on behavioral biases, and what I wanted to do today was take one of those, just share with you what it is, give you some examples of how it works, and then hopefully help you understand how to minimize its impact in your decision making. And to illustrate this example, I will use this coffee mug. So this is a coffee mug that I own, and let's say you had this mug, right? And you had a bunch of mugs, and this is one of them. This particularly doesn't mean a ton to you. The Walden School that's listed on here doesn't mean a lot. It's just a great way to hold coffee or tea or whatever you want. So if you would break the mug or lose it or chip it, you had to throw it away, wouldn't be a big deal because it's just a way to hold coffee. You've got plenty of other mugs, right? No big deal. For me, though, this mug actually has very special meaning because the Walden School that's illustrated on here is a musician's retreat, or one of their functions is holding a musician's retreat every summer up in the mountains of New Hampshire. And I was able to go there a couple years ago and spent an amazing, unforgettable week composing music, arranging music, singing and playing with the other attendees, learning from some expert composers and conductors. It was amazing. It was transformative. So for me, every time I see this mug, it reminds me of that very special week, those special memories, takes me right back to it. So for me, this mug actually has a lot more value than it would if you owned the same mug. And the same thing tends to happen with our portfolios, right? The stocks that we own or our holdings, we attribute greater value to it just because we own it. And that's what endowment effect or the endowment bias is. It's basically you treat things that you own differently than things that you don't own, purely because of the emotional attachment to that, to those items. So what happens is this is how it manifests itself in your investing. You're doing fine, your portfolio is doing well, and a couple of your holdings start underperforming. They start rolling over. And let's say it's Disney. It's a stock that you've owned for a while. You love this stock. You love the company. You love the story. You're in for the long term, and it really starts to hurt your performance. What endowment effect does is it basically compels you to want to continue to hold it even when the evidence more and more demonstrates why you should exactly not be holding it. So the problem is it starts to really hurt your performance because of your emotional attachment to that particular stock. So, the way a couple things, I think a couple tricks that you should keep in mind to help minimize this lack of action that you will take on some stocks that you own because of the endowment effect. Number one is the new money trick. So what I always tell people is, if this is a stock that you're holding and you're debating whether or not you should still hold it, the question is, let's say you had new money today, you had new capital that you needed to invest, would you put it in this stock right now? And if the answer is yes, then that's great. Then probably you have some good justification for continuing to hold your old position. But a lot of times you'll find the answer is no. Well, no, I wouldn't put new money in it, but I'm okay still holding that. And it's like, well, hold on a second. If you wouldn't put new money in it, can you really justify why you should be keeping old money in it? So that's number one, is do the new money trick. Number two, cover up the tickers. So if you look at charts, which hopefully you do, because it's a really good way to understand market history and price and dynamics, is cover up the tickers. Take some of the stocks that you own and take a bunch of other charts, put them in a big pile, cover up all the tickers, and then look at the charts individually and analyze them and see which of the charts you find most attractive. Then uncover the tickers and see if the charts that you own are the same ones that you identified as the ones that you would probably most likely want to own. And if there's not an overlap there, if there's a disconnection there, then see what it is about those charts that maybe are not as attractive as you might have thought, because that'll disconnect you from the emotional attachment to the stock, to the company, and focus more on the evidence. The third one is to remember that think of stock positions as things you rent, not that you own, right? A lot of times again, you have a responsibility as a shareholder when you own shares of a stock. Totally fair as being essentially providing oversight for the company. So I'm not talking about that. I'm just thinking mentally how you approach your current positions. Think of your positions as things you're renting. And at any point you can break the lease, get out of it with no penalty, and move on to something else, as opposed to something that you buy that you therefore have to have an emotional attachment to. You're just there temporarily until your money is better suited elsewhere. So folks, that is a summary of the endowment effect, how it manifests itself in your portfolio, and what 3 tricks you can use to minimize its impact in your decision making. Hope this was helpful. Check out some of my other videos, and have a great day. Be safe.